Right. Welcome back to Principles of Accounting 2. I was just saying that time goes by super, super fast. And we're already at middle of November. I was just looking at the calendar. It just goes by so incredibly quick. So let's take a look at the classroom. And I want to show you a couple of things here in the classroom. So bear with me. But I wanted to show you where we are today, where we're heading next week, and then the following week. And that brings us basically to the end of the semester, right? Um, so we're currently sitting in week 12. And for this week, we got which is nice. We just have the chapter 24 quiz to take care of for Sunday. Now, next week, we'll meet on the 20th, which is next Thursday. We'll meet on the 20th, next Thursday, and we're going to talk about relevant costs for decision making. Fun topic. I like that topic a lot myself. But also that week, we have another LinkedIn Learning certificate. So next week we have a LinkedIn Learning certificate, week 13, and it's on using artificial intelligence in accounting, which a very fun topic. I really enjoy that one because the way that AI is moving now, it's making a lot of things automated for us, especially on the accounting side of things. So for those of you who are owning your own business, planning to own your own business, working in other businesses, anytime you have to work with accounting, the great thing is a lot of things are becoming automated. So it's really saving us a lot of time, and we're able to be more efficient in running the business rather than focusing on just the bookkeeping work. So that one's going to be a lot of fun for you, I think. And so that's next week. You'll have your LinkedIn Learning Certificate on artificial intelligence in accounting, and you'll have the Chapter 25 quiz. And then in 2 weeks from now, we have week 14, which is on capital budgeting and investment analysis. That's the last chapter in the book. And for that, we just have the quiz for chapter 26. And then the following week, which is the very last week of classes, we have a nice report for you to write. And this report, it's relatively short, but it's something that I felt like was something that needed to be done for us. And so I want you to use some AI to help you to write this. You know, ChatGPT, Gemini, Claude, whatever writing assistant that you prefer. I want you to analyze and apply some financial accounting concepts that you learned. So you'll select one of these from the list below. You'll use AI to write about the topic that you've selected. And then what you'll do is you're going to take that information and you're going to summarize it. Uh, and, I really want you to identify two questions that you asked the AI to help you in writing this. I want you to reflect on the usefulness and the limitations of the response and show how this is connected to real world decision making in business. So, relatively short, 300 to 500 words, single PDF doc or Word document, whatever you prefer. But that'll be the very last thing that we're going to do in this course. So that'll be the final week. So no need to stress over that now. I just wanted to call your attention as to what's coming up over the next few weeks. So you're more than some of you have already worked ahead, which is great. I'm all for it. If you want to do that early, you're more than welcome to as well. But that's the last thing that we'll do for this course, besides the final exam, of course. So that's where we are and where we're heading. So what I'd like to do now is bring us back. into the current week, which is week 12, performance management and responsibility accounting. And that's going to be the bulk of our discussion for this evening. So let's talk about these concepts: performance management, responsibility accounting. Uh, there's a couple of things that you as managers really need to know about, and one of those is being able to control your costs. Super important that as a manager you control the costs of the business. Anything that you can control, that is. You can control things like the amount of inventory you have on hand in your department, how often your employees work, uh, some overheads like repairs and maintenance, those smaller things. Yeah, you need to be able to control those costs because ultimately we need to evaluate who's responsible for those costs and also how efficient the business is and management is at controlling those costs. And we're going to do that in a couple of different ways. We're going to look at um, what we call profit centers, or I should say cost centers, profit centers, and investment centers. We call them centers. It's more or less of a grouping of like things together. So when we talk about controllable costs, so there are costs that each manager can control. Those are costs are contained into what we call a cost center. We'll look at um, uh, the profit center, based off of the sales that you've made within your department minus your costs. We'll look at your profit. And we'll also look at the investment center, which are how well we're using our assets to help us to generate sales. So we're going to look at those areas. We're also going to look at a couple of ratios and overall effectiveness in management. That's what we mean by responsibility accounting. Yeah. So, so let's take a look at responsibility accounting through our controllable costs, and we're going to talk about how we evaluate the performance of management and the company based off of these cost, profit, and investment centers. So, as a manager, you're responsible for controlling costs within your purview. Okay, if it's within your ability to control costs, or you have the ability to influence costs, we call those controllable costs. That's what a controllable cost is. We also have costs that are outside of your control as a manager. We call those uncontrollable costs for the obvious reasons. So as we're looking at those type of costs, we need to be able to evaluate and understand who's ultimately responsible for controlling those costs. We call this responsibility accounting. It's where the managers are evaluated based off their ability to control costs. Yeah. And we measure management's performance to control costs based off of the cost centers, profit centers, and ultimately the investment centers. A cost center is the costs that are generated in the business without generating revenue. The manager controls the controllable costs within the cost center. Within the cost center, we're comparing the actual costs to the budgeted amounts. So what actually happened, we're comparing that to the budgeted amounts, and we're only looking at the costs that management can control. That's what a cost center is. We also look at the profit center. We evaluate, and this is the revenues minus the costs. The profit center management is evaluated based off of their ability to generate sales. Okay. Management makes sales. We subtract the sales from the cost. That's the profit. We evaluate management based off their ability to generate profit. We call that a profit center. And the last area that management is evaluated on is called the investment center. This is how well the managers are utilizing the assets of the business to generate sales. Okay? That's ultimately what an investment center is. They generate sales minus the costs. They're all controllable to help management to make investment decisions. So ultimately, what's happening here in the investment center is we're evaluating the manager's ability to use the available assets to generate sales. So we evaluate management based off of these three centralized areas or centers, if you will. And as I had mentioned, the performance of management is based off of their ability to control costs. So controllable costs are the costs that managers have within their purview. It's within their ability to influence those costs. We also have uncontrollable costs that are outside of management's control. So I'll give you a couple of examples of controllable and uncontrollable costs. Controllable costs might include things like the wages of the hourly employees within the department. Management can control that. The amount of time employees are spending on developing a product. Management can control that. The amount of office materials or materials being used in the manufacturing process. Management can control that. Those are all controllable costs. What management cannot control, or the uncontrollable costs, would be like the manager's salary. Manager cannot set their own salary, so that's an uncontrollable cost, right? Management cannot dictate how the power is distributed to the facility, so electric expense, uncontrollable cost. Utilities, uncontrollable cost. Yeah. So management can only control what is in their purview. Everything else is uncontrollable. So I'd like you to take a look at uh, this, what do you call this? Organizational chart, org chart. This org chart represents a very popular food and beverage company. You may have heard of them. We call them Pepsi or Coca-Cola, right? And so both Pepsi and Coca-Cola, they have ways that they allocate who's responsible for what. Okay. And it gets all the way down to the manager's level and goes all the way up to the president's level and ultimately to the board of directors. The board of directors is responsible for setting management. They select the president of the company. They vote on changes to the company, but they don't directly work for the company. The company reports to the board of directors. And the board of directors, they're elected to the board by the shareholders. Shareholders elects the board of directors. Board of directors helps management to set the tone of the business, okay, to guide the business. The president, who's elected by the board of directors, has direct reports. Those direct reports are the vice presidents. And for Coca-Cola, the vice presidents are broken out by region, so geographic region. Europe is one, United States is another, and Asia is a third. Within each region, the vice presidents have factory managers that report to them. So, for example, in the United States, there's two factory managers. There's one in the West and one in the East. Both those managers report to the vice president for the United States. And then within each factory, there are departments. There's the beverage department, the food department, and the service department. And those departments have managers, and those managers report to the factory directors. Factory directors report to the vice presidents. The vice presidents report to the president. The president reports to the board of directors. Board of directors reports to the shareholders. And that's a typical org chart for a publicly traded company. And this is a typical org chart for a company like Coca-Cola or Pepsi. So it's important to note that each level of management has a certain responsibility. They're responsible for their controllable costs. So we can take a detailed look at those controllable costs through this report called a Responsibility Accounting Performance Report. It lists out the actual costs that managers are responsible for and their respective budgeted amounts. We compare the actual to the budget, we get the variance, and that variance tells us about the performance of the manager and their ability to control their costs. So I want you to take a look specifically at the beverage department for the Western Division of the United States. So within the beverage department, the total department as a whole was over their budgeted amount by $300. Okay, this could be good or bad. It depends. What do you mean by over? Were they over by sales? Were they over by expenses? Well, it turns out that we zoomed in on the beverage department within the Western Division of the United States, and we found that direct materials, direct labor, and utilities, which are all controllable costs of the beverage department manager within that factory, they were over budget on their direct materials by $900. They were under on direct labor and under on utilities, which led to a total overage of $300. So, ultimately, this could be not great news for the manager of the beverage department. It's not $300, it might be $300 million. Okay? Think big, all right? This is Coca-Cola here. All right? So, not great. You're over budget by 300 million. So, the beverage manager responsible for direct materials, direct labor, and some factory overhead, whatever's within their controllable amount. That rolls up to the plant manager or factory manager as a line item, right, for that department. The factory manager is ultimately responsible for salaries, department managers, the building rent, insurance, the beverage, food, and service departments. So this responsibility falls on the plant manager. Now take a look at all of those controllable costs that the plant manager has. One of those line items being the beverage department over by 300 bucks. There's other, or by $300 million. There's other line items where that are also over budget. Salaries, department managers over budget. The food department is also over budget by a lot. So ultimately, the whole factory is over budget by 2,800 bucks. Now that plant manager probably in a lot of trouble because they overspent by $2.8 billion. Okay, kind of a big deal. So what happens? The vice president of the United States for Coca-Cola gonna be a little upset with what's going on over in the West, right? So because they see, hey, Western factory, you're over by $2.8 billion. So I would suspect that some people gonna get fired, right? I think the plant manager in trouble. I think the manager of the of the beverage department in trouble. I would suspect that the food department manager be in trouble. So, but the point is, this report details the responsibility levels for each level of the organization. Now, remember, the managers are only responsible for their controllable costs. That's why we have these controllable costs listed out like this. So, um, when it comes to the departments, it's also important to understand that the individual departments they have direct expenses and indirect expenses. Direct expenses I can trace directly to the department, the direct materials, the direct labor. But there's other factory overhead that I cannot easily trace directly to the department, like utilities. You know, the electric expense for the whole factory. I can't just give that to the beverage department. It's got to be shared across all the departments within the factory. So I'm going to show you how we allocate those expenses. So as I'd mentioned, direct expenses, these I can directly trace to the department. They include things like direct materials and direct labor. And I have indirect expenses like utilities that I cannot easily trace. All right. So for indirect expenses like utilities, I have to share that expense with all of the departments to spread them out. Yeah? So I'm going to show you how that works. So to allocate indirect expenses, we take the total cost to allocate. So in this case, the total utility bill for electricity for the factory. And we multiply that amount by the percentage of the allocation base used. So what I would do for the utilities is I would allocate that based off of the square foot of each department. So if the beverage department has, you know, 300,000 square feet and the food department has 200,000 square feet, that's a 500,000 square feet, right? I would allocate the utility based off the square foot. So I take the electric bill, multiply that by the square foot, and by the percentage of the square foot. Yeah, and that would give me the allocation. Now the percentage of square feet, I take the uh, total square feet of the department. So in this case, 300,000 square feet for the beverage department. Now divide that by the total square feet of 500,000 square feet. So 300,000 divided by the 500,000, that gives me the percentage of allocation base. And I multiply that by the utility bill. And that's the amount that I would allocate to the beverage department for utilities. It's pretty straightforward overall, yeah. So service department costs are shared by two or more departments, and those service departments include uh, personnel, payroll, and purchasing. Now, the back office has expenses. I got my office personnel that take care of sales, office personnel that take care of payroll processing, purchasing, general maintenance of the facility. And so I allocate those expenses as well to the operating departments. So we take these service departments and we allocate their expenses to the operating departments. The operating departments in our earlier example being the beverage department and the food department. I'm going to give you an example, real easy, very easy example of how this works. This is a retail store, very small retail store. This retail store, they happen to sell jewelry um, at their retail store. Fine, well, so let's say it's fine jewelry, okay? They sell jewelry. They also do jewelry repair as a service. So jewelry and jewelry repair. Oh, and they also sell clothing. Okay, so these are the three operational departments: jewelry, repair, and clothing. Okay, it's a small retail store. It's only 4,000 square feet. Maybe it's in a strip mall or something like that. And they sell jewelry, they do jewelry repair, and they sell clothing. It's a boutique. Let's say it's a boutique store. Okay. Now, we received a cleaning bill for 800 bucks to clean the entire store. Now, obviously, I can't just allocate that to one department. That wouldn't be fair. I need to allocate it to each of the three departments. And the way I do something like cleaning service or utilities is I allocate it based off of square feet. Now, it's a 4,000 square foot store. Jewelry department has 2,400 square feet, repair department 600 square feet, and clothing is 1,000 square feet. So it's pretty easy to calculate the percentage of square foot. We take the square foot of the department and we divide that by the square feet of the total store. So 60% for jewelry department, 15% for the repair department, and 25% for clothing department. So based off of those percentage allocations, I take the total amount of the bill, 800 bucks, I multiply it by each percentage. So 800 times 60% is 480. 800 times 15%, 120. 800 times 25%, 200. And those are the amounts that get allocated to each department. It's very simple. It's a very simple process. But that's the process for allocating indirect costs to the respective operational departments. Now, I can look at how well each department is operating by creating what we call an income statement for each department. So we call those departmental income statements. And they work just like any other income statement does for a company. We have our sales that are generated, our direct expenses, and our indirect expenses. Sales minus cost of goods sold equals gross profit minus your operating expenses gets us down to our net income. Now, I can look at this on our operating departments. Now, before I'm able to identify the net income for each department, I need to first figure out my direct and indirect expenses for my service departments and allocate that total to my operating departments. After I've allocated my service department costs to the operating departments, I can then formulate the income statement for the operating departments. So I take my sales minus my direct expenses like direct materials, direct labor, minus my indirect expenses like factory overhead, which would include things like utilities and supervisor salaries, those kind of things. And then minus my service department allocation gets me to my department net income. So again, it's formulated the same way that any other income statement is. So it's a step-by-step process. First step is we look at our sales and indirect expenses by the department and our total indirect expenses. So here we have sales for our two operating departments, because obviously the service departments, they don't have sales. They're there to support the operating departments. So in this example, I have a company that sells outdoor equipment. We have hiking and camping. So we have sales for hiking and camping, and we minus our cost of goods sold equals our gross profit. And then we have our direct expenses for both hiking and camping, but I also have some expenses, direct expenses for our service department, 15,000. And I also have depreciation expense for the equipment used in hiking and camping, and also my service department, 2,000. And then for the whole store, I have rent and advertising. Total expenses 208. So once I have all of my sales and expense, direct and indirect expenses figured out, I step two, allocate those indirect expenses to all departments. So I have rent and advertising. Those are my indirect expenses. Rent was 12 grand, advertising was 4. I'm going to allocate the rent based off of the square feet. Makes perfect sense. And I'm going to allocate advertising based off of sales. Also makes sense. So the rent, 12,000 bucks, I allocate to all departments, both operating and also support. So support, I got purchasing department. For operating, I have hiking and camping. Figure out the square footage. Whole square feet of the store is 9,000. I take the square feet of each department divided by the total square foot of the store to give me the percentages. Take the percentage times the 12,000 bucks for the rent, gives me my allocated rent. Okay, do that for each department. Then I have my advertising that I allocate only to the operating departments because the service departments or support departments, they don't have sales. Only the operating departments do. So I take the sales amount for each, get my total, take the sales amount for one department divided by the total, gives me my percentage sales. Take that percentage sales, multiply that by the $4,000 bill for advertising to get my allocated cost. I do that for all operating departments. So that's step two, allocating the indirect expense. Step three is then transferring or allocating the service department expenses to the operating departments. Now, as you know, we have the purchasing department, and we have a total expense after the allocation of the rent of 19,400. And this is based off of the number of purchase orders from each department. So, just like I did before, I identify the number of purchase orders for each department. In this case, 840 for hiking, 360 for camping, total 1,200. I take the number of purchase orders for the department divided by the total purchase orders, gives me the percentage. Take that percentage, multiplying that by the total amount of the department, in this case 19,400, to get me my allocation. Okay. Once I've done that, I can then appropriately ensure that everything has been allocated to the operating departments. And there at the very bottom, we can see the allocation of all the expenses, direct, indirect, and the service department allocation. So steps one, two, and three. Once those are completed, I can then formulate my department income statement for my two operating departments. Sales minus cost of goods sold equals gross profit minus your expenses that have been, which include direct, allocated indirect, and allocated service. Sales minus cost of goods sold equals gross profit minus total expenses equals your operating income. In this case, the company combined is an operating income of 19,000. But based off of this information, I can effectively each manager of each department, I could effectively manage them uh, because almost all of these expenses are within their control. Okay, I can manage them based off of their sales. I can manage them based off of their controllable expenses. So that covers your uh, cost center, that covers your profit center, and then eventually we'll talk about the investment center. Uh, we can also see the contribution margin from each department, as you see through the gross profit, uh, and the amount of overhead that is also contributed based off of each department. So I would manage my managers for each department based off of their controllable costs. Their controllable costs, their revenue, you know, revenue minus the cost to get the profit center, and then their cost center. I'm managing my managers based off those two things, and then partially I'll manage them on my investment center, which is the utilization of of our assets. I'm going to show you what that looks like here now. So the investment center managers are responsible for the revenue and costs based off of the revenue that's generated using the company's assets. So here I have an example of a company that manufactures both LCD screens and phones. All right. Obviously, both of these are complementary. They could both be used for phones, uh, or the LCD screens could be used as computer monitors. Okay. Um, so um, for the screens, we have 750,000 in net income for the year, and we have average total assets of 2.5 million. For the phones, the smartphones, we have 370,000 in income, and we have average assets, average total assets of 1.85 million. So I want to be able to calculate the return on the investment for both of these line items. And the way that I would do that is I would take my income from each area divided by the average assets from each area. So for the LCD screens, 750 divided by 2.5 mil gets me 30% return on investment. For phones, 370 divided by 1.850 mil gives me 20%. Now, once I have my return on investment for each area, I would also want to calculate my residual income, which is the income that I would earn from each additional sale thereafter, right? Read the word residual, you know, what's left over. So the residual income, we calculate that by taking the income minus the target income. Management typically sets the target income for the company. And in this example, management decided on 8% target income. Okay, easy peasy. So the way I do that is I take uh, my income amount minus the target income. The target income we take from the average total assets multiplied by the 8%. So average total assets divided times the uh, target income percentage. That gives me my target income for each item. So income minus target income equals residual income. So obviously we want these numbers to be positive. If they're negative, then there's a problem with that department. Another thing that management would need to do to ensure that the company's overall performance is meeting expectations for each department, uh, and to ensure that the company is utilizing their assets to help them to generate sales appropriately, is to calculate the profit margin and the investment turnover. So to do this, we need to find the return on investment, and the return on investment is calculated by taking profit margin times the investment turnover. To find the profit margin, we simply take our net income divided by our sales. And to find our investment turnover, we take our sales divided by our average total assets. So for the LCD, we have income of 750 divided by sales of 9.375 million, uh, which gets us to 8%. And we then take that 8% and multiply that by the investment turnover. For the LCD, that's sales, 9.375 mil, divided by average assets, in this case, 2.5 million, getting us 3.75. So take the 8% times 3.75, and that will give me my return on investment for the LCD. I follow that same exact logic and process. I'm sorry, follow that same exact logic and process for the phone as well. And that will give me return on investment. Now, it's important for management to not only evaluate on department level, but also on a company-wide level or on a department level that encompasses multiple aspects, both financial and non-financial metrics. Now, in our investment center, I manage the company based off of this thing called a balanced scorecard. And this balanced scorecard takes into consideration both financial and non-financial information. And we look at it from four primary categories. One is our customers. We want to understand what our customers think of us. The second area is our internal processes. These are the operations that are critical for customer success. The third area is what we call innovation and learning. This is what we call research and development. And the fourth area are our financial metrics, which include things like net income, return on investment, sales growth, profit margin, residual income, and investment turnover. We call all of these things combined key performance indicators, also known as KPIs. Uh, and these KPIs helps management to set the direction of the company, evaluate the performance of the company to better understand how well the company is utilizing their assets to help them to generate sales. So that's what this balanced scorecard ultimately does for us. So everything we talked about to this point is how we evaluate the company's performance by looking at their cost centers, profit centers, and investment centers. The next thing I want to talk about is what happens when two or more departments need to be able to move inventory from one division to another. When that happens, management needs to decide on a price. We call that a transfer price. I'm going to talk about this here in a second. So, a transfer price is the price used to transfer a good from one division to another. Okay? Very, very simple. So, let's say our earlier example uh, of the LCD screens and the phones. We need to transfer LCD screens from one division to another. Okay, from the West Division to the East Division or whatever. Okay. So what happens is that the managers from each division get together and they negotiate what we call a transfer price. The transfer price is the price that it will cost to transfer the inventory from one department to the other. So they negotiate a price. That price is anywhere between the price it costs to make it, right? The manufacturing cost, and the price to sell it on the market. We call it the market price. The transfer price is going to be somewhere between these 2 points. Typically, the companies will select the lower of the transfer price, which is somewhere around the manufacturing cost. So it'll probably be about $30 in this case, will be the transfer price. We try to keep it as low as possible. It might be $32, but we try to keep it as low as possible. But that transfer price will always be somewhere between the manufacturing price and the price that we would pay on the open market, also known as the market price, or the low and the high, if you will. So in some cases, the company might run out of what we call capacity. All right. What we mean by this is that one of the departments no longer has space or the ability to produce additional units of one product or the other. Call it no access capacity, transfer pricing. So if there's no access capacity in, let's say, the LCD department, we would transfer it uh, to the phone department. And that transfer price would probably be closer to the market price because that there's no capacity that exists. Brianna, that's an awesome question. I like this one. Is it like how a deli department transfers a product from a grocery store department? It kind of, yeah. But the way I would think about it, Brianna, is let's say it's two grocery stores in the same company. So let's say uh, um, you have Safeway in one town, Safeway. The Safeway in town A ha has no more room for their deli products. And so they're going to transfer that additional inventory over to the Safeway in town B. And so it'd be like between two different stores in the same company or two different divisions in the same company or something like that. But it's typically involves two different facilities, so not usually within the same facility. So I hope that helps to clarify that question. But that's an excellent question. Appreciate you asking that. So in this example, we have the LCD division and the phone division. The LCD division is out of capacity. They cannot produce more, so they're going to transfer it to the phone division. That transfer price is going to be closer to the market price because they don't have any room. Now, if the company did have additional room, that transfer price is probably going to be closer to the manufacturing price because they have that additional capacity. But in either case, the cost of the transfer price, is going to be somewhere between the manufacturing price and the market price. So that is transfer pricing. The next thing I wanted to briefly talk about is a ratio that we call the cash conversion cycle. And this is a really important measure to understand because it tells us about how long it takes for the company to collect cash from their customers, right? Super, super important to understand this because it measures how long it takes to collect cash from their customers, to convert the cash outflows into inflows. Yeah. So there are three components that we need to calculate in order to find the cash conversion cycle. The first is called the days sales uncollected. Days sales uncollected tells me how long it takes to collect the cash from an account receivable. When we sold the inventory to our customer on account, they haven't paid us yet, that's an account receivable. How long it takes for the customer to pay us their account receivable. Call it days sales uncollected. And then we take the account receivable total on the balance sheet, we divide that by our net sales on our income statement. Then we multiply that by 365 days. That gives us days sales uncollected. The next component we need to calculate is called days sales in inventory. In this, we take our ending inventory amount on our balance sheet divided by our cost of goods sold on our income statement. We multiply that by 365 days. That's days sales in inventory, how long it's sitting on the shelf for. Yep. The third component we calculate is called days payable outstanding, how long it takes us to pay our bills. We take accounts payable total on our balance sheet divided by cost of goods sold on our income statement times 365 days. Now, once I've calculated those three components, I pump them into the cash conversion cycle formula. So we take days sales uncollected plus days sales in inventory minus days payable outstanding. That gives me my cash conversion cycle, which ultimately tells me how long it takes to collect the cash from our customers in the long run. So here we have an example of the American Productivity and Quality Center, and they tell us how long on average it takes for companies, right? So days sales uncollected, 13 days, plus days sales in inventory, 63 days, minus days payable outstanding, 67 days. That gives me a cash conversion cycle of 9 days. So 9 days is pretty good. In this case, we want the shortest amount is typically good. Yeah. All right. Another thing I need to talk about is called joint costs for products. Now we know that companies have more than one department. For example, the LCD department and the phone department. And those departments oftentimes share costs across a single product. We call those joint costs. Shared costs are called joint costs. Joint costs are the costs that that are are used to produce or purchase two or more products at the same time. Yeah. Some manufacturing involves joint costs, which are the costs incurred to produce two or more products at the same time. An example of that would be dairy. Uh, when it comes to dairy, milk can be further pasteurized into whole milk, 2% milk, 1% milk, skim milk. Um, and the costs are based off of the processing, right? The further processing of that milk. So those costs we call as joint costs. They're split off to and allocated to each product that's produced. So I can show you a quick example of that. So here we have our joint costs. Um, so the way that we do this is we take our total sales to find the percentage of the total. So, for example, for whole milk, $12,000 divided by total sales of 50,000, that gives us 24%. We then multiply that by the allocated cost, uh, uh, and we get the gross profit part. So, pretty straightforward. It works very similar to the allocation of indirect costs. Yep. And that, my friends, leads us to the end of our discussion today on performance measurement and responsibility accounting. Just to quickly recap as to what's due for the Sunday night, we have a couple things going on here. So here we are, week 12. We, of course, have our Chapter 24 quiz, which is the only item that we have due for this Sunday night. But I do, again, call your attention to next week, which starts this coming Monday. We're going to have our class on the 20th of November, which is next Thursday. In that, we have a LinkedIn Learning certificate called Leveraging Generative AI in Finance and Accounting. It's a great one. I really like this one. I would encourage you to do this one early so that way you don't have to scramble next week to do two things, yeah? If it's easier for you that way, yeah? Just want to make your life a little easier. I'm encouraging you to work ahead. Just to make your life a little easier. Because next week we have two action items. That certificate and then the chapter 25 quiz. Then the following week we have our last chapter, which is capital budgeting investment analysis. And then we have a short essay on generative AI and future in accounting. And then after that, that brings us to the end of the semester, and we have our final exam. So that's what we got ahead. Any comments, questions, concerns that you have? that I can help to address at this time?
I don't have any questions.
Awesome. Thank you, Genesis. I appreciate that.
Health insurance companies the ability to deny people
Caleb, you
coverage
good?
if they are.
Yeah, no, I'm cool.
Awesome.
So
Thank you. I
this
appreciate that.
Professor, I was a little bit late, but I came in,
That's
so I
okay.
just want to make that known.
I appreciate you letting me know, Zari. Appreciate that.
Thank you.
My pleasure. Great. Okay, so if so that's all I got for you for this evening. If you need anything, you can always reach out to me. I'm here for your support. I'm here to make you as successful as possible. So I appreciate all of you. Appreciate your time this evening. I hope you have a wonderful rest of your night, and I'll see you all again next Thursday. Thank you so much. Appreciate you. Have a
Bye.
great
Have a
night.
good one.
Thank you too. Take care. All right. Bye-bye. Take care. Good night. Bye-bye.